Hey everybody, hey traders, Chris Powell here. Just around 5 p.m. Eastern time on Monday the 21st, markets had another red day. We gapped to the downside, future flows negative coming Sunday into Monday's open. We had another 2+% decline. We were at 3+% on the S&P intraday. Here is a look at SPX pricing for the day. We gapped lower, proceeded all morning to the downside until we found a bottom around 2:15 to 3 p.m. In the final hour, we rallied about 1.2%. To get back to what I saw, some pretty interesting starting levels for the day. I do a lot of day trading on SPX, and these started out to be right around that 15 to 20 delta at the very end of the day. It was not worth hanging on to the risk this morning, so I did take some small day trade losses. Ended up grabbing a nice little butterfly spread that paid out nicely to the pin around 5,100. I didn't need it to get there and stay there all day. Obviously, this debit cost me about 30 cents and closed it out for about $1.25. So net on the day was positive, which I'm happy with. I wanted to go back and revisit. Number one, big thank you to the TradingView community for a lot of new followers and supporting my idea. I posted a video called SPX Key Levels or S&P 500 Key Levels to Watch, and so I wanted to kind of piggyback on that and just express. Look, I think that we are continuing to see a lot of noise out of the Trump administration. Technically speaking, I do think there are some buying opportunities at these lows. Now, to be mindful of this, I mentioned in that S&P key level video, we have major resistance here and we have major support here. Anything in between is truly a bunch of noise. Now, that doesn't mean we don't have good trading opportunities. If we get close to these levels, or I would say anywhere between 4,900 and even down to like 4,600, I know that seems pretty wide, but it's enough to kind of scare the market, right? If we came down and tested 4,800 and we breached, 47, 4,600, it's going to scare everybody. But I think there's going to be some contrarian signals that we can play. Sentiment would be terrible. We're going to be back into oversold territories. We might even have market breadth at the pain points like we saw with this initial rally where everything in the S&P was, basically below the 50-day moving average. So if that offers a market breadth buying opportunity, I will look to set up some option trades to take a bite at these lows. It doesn't have to be perfectly timed. But if I give myself, 30 to 45 days, I think that's enough to get a reflexive move and a little risk on move to get back into this kind of range trade where this is currently, this is the S&P no man's land. But if we come back down to retest the lows, I'm willing to actually take some bites there. So anywhere between around 4,900 and 4,600, looking to stagger in some, most likely some debit spreads, trading some options, and looking to see if the market can just come back in. I mean, literally a 1 to 2% move in the underlying can get enough profit paid for, a simple debit spread or even a synthetic long. So some option trades that might work out pretty nicely. I will zoom in a little bit here because going into a 4-hour chart or 1-hour chart, I had mentioned this for some of these key levels. Let me go to the 1-hour chart. This might be a little bit easier to explain some wave structure. So you got to ignore some of this noise, and I apologize for having fibs and EMAs and stuff, but I'll just draw through the swings here. So this move from the low to the high, I'm just going to call that a swing. Okay. Now, immediately when we had that push on Wednesday, this is Wednesday, April 9th, the next day the market pulled back and tested this low. That's what I think today was. I think today we started out to retest this level. This is a very common price action play where we have a swing from low to high. We pull back, we fail at the high, we pull back again, and we form a flat pattern. This week might actually finish positive. What could be the catalyst? Possibly earnings. We have, I think, over 400 companies reporting earnings this week. Some notables would be Verizon, AT&T, Intel, Google, Tesla. There's a bunch of other ones, but those are some of the big ones, especially Mag 7 like Tesla and Google could be a big one. Tesla is obviously down 40+% year to date with high to lows nearly 60%. And I do have some shares of Tesla. I was assigned actually on the 17th with a break even around 247. I put in some puts to protect the downside. I don't have anything capped on the upside. So if Tesla has a good earnings report, I'm hopefully getting it called away at a 250, 255, 260 level. If it has a bad report, I have a 150 out of the money put. That's some pretty good protection. I'm willing to sacrifice $480. And if I can turn that into a couple $1,000 of protection, lower the cost basis, then I'll aggressively start selling some covered calls. So long story short, I mean, what could stabilize the market this week? Probably earnings. Maybe President Trump has to just be quiet for a little bit. He is saying things that aren't making any sense to what the market is actually doing. So I'm sorry, but you can't jawbone the Fed. You can't jawbone the markets and say that we've done it. Everything is great. Look at inflation is down. There is no inflation. That's total BS. Look, if the Fed were to cut rates the yields are going to continue to go higher and have the adverse reaction like we saw last September. The Fed is not going to cut rates. They're not going to cut rates until probably June. That's if they cut rates, but they're not going to budge right now. And the fact that Trump is being vocal about talking to, saying that he has the authority to fire Jerome Powell and replace him as Fed chair is crazy to me. But it's 4 months into a new presidency, and I don't forget about the last 2016 to 2020 when that was crazy. This is crazy 2.0. So anyway, point is the Fed isn't going to do anything. Inflation is still sticky. This is, I mean, if you want the data, here's my takeaway point. Liberation Day announcement was after market close right here when the 10-year rate was sitting at 4.13, and then for 2 days as we dumped lower, as the market dropped on the Liberation Day announcement, 2 days to the downside, we had the government, i.e., the Trump administration, celebrating a win, saying that, look, the 10-year rate's below the four handle. What would happen next week? The exact opposite. So here we are at Liberation Day announcement. The yields are actually higher. This is potentially exacerbating that air pocket that everyone keeps worrying about with the refi rate, with government interest, as well as consumers trying to refi small business, any business, IPOs, SPACs, like whatever you need to get into business. If you're looking at generating cash flow or getting a runway, you're not going to get it at 4.4%. You're going to borrow way, way less because it's much harder to pay back than what we've had as decades with low interest rates. So my biggest concern is that the Fed, even if they start cutting rates in June, it doesn't matter because yields are going to be higher. So unless this stabilizes, which means we should start to see this going back down, if it doesn't, and this keeps trickling higher, we go to 4.6, 4.8. An interesting point would be, look, this is where we had the Trump put was announced right here at this high at 4.59%. You go to the US 20 year, this high was the Fed put, or not the Fed put, the Trump put, where he started to back off and put in a 90-day pause. So that was around the 20 year hitting a 5% move. So are we heading right back up there again, and pressure will be on the government, on the Fed? I think it's a horrible idea if the Fed has to cut rates because truthfully, the Fed, if they're going to come to the rescue, it's not at a 20% low. I'm sorry, but it shouldn't be at a 20% low. Yes, I understand that the Fed is always reactive and everyone blames them for being reactive and they never do things right. They're always, missing the timing. Their job is not to time anything. Their job is to provide stability and liquidity. And in this environment, if things get worse, stability and liquidity are going to be required in here. But the problem is there's nothing good. There's nothing good in here outside of a bear trap. If the bear trap comes in, then sure, there is a backstop potentially to curb this entire scare. We have sentiment that is some of the worst ever. I think the University of Michigan sentiment was the lowest reading ever in history. We've had 8 or 9 weeks consecutive of AAII sentiment that has been over a 50% bearish reading. That that's extreme. So it's not a signal to be contrarian, but man, it just shows how nasty sentiment is right now, and how scared and nervous everybody is. So look, I think best case scenario is the market. If we zoom in on that swing, that this is it's a rough way to start the week. I'll admit that, right? Rough way to start the week, especially coming off a pretty quiet week going into Easter, and having a holiday week last week with Friday off. If the market can use this as a low and spend the rest of the week fighting back, good. Then this to me is a low to high swing, a flat pattern that comes back up and maybe refines this 200 moving average. If earnings comes in relatively solid this week, if consensus is decent, I can see the market rallying. And we just started off on a rough patch, but we filled the gap and continue to go higher. So, I mean, as far as waiting for things to settle in, I'll be watching earnings this week to see how it plays out. It's two ways, right? I'm not doing a lot of directional trading in here. I'm doing a lot of neutral trading. I'm doing a lot of income trading in here. I will get more directional. If we are up to this high, I will start looking for hedges. If we are down to this low, I'm going to start looking for probably 40 to 60 to 90 day bullish trades. And that could be at 4,800, that could be at 4,700, and that could be at 4,600. I don't think those are necessarily going to be losing trades, but if they are losing trades, I do hedges from this area all the way down, and I have hedges that are still running from the very beginning of the year all the way down. That is portfolio protection for me. But if we come down to these lows, my hedges, I might take some short-term hedge trades off. I will start taking some bites that are bullish. Let me delete this so it doesn't make too much of a mess here. But if we come back down to 48 and change or 47 or 46, I'm looking to get long for a bit of a recovery. That would be my bear trap scenario. That to me would give me the confidence to take some stabs, to find risk, and be directional to the upside. The bearish side would be we come back into support becoming resistance. That could be anywhere between 5,500 and 5,700, and also looking to reapply some hedges. I don't necessarily need to time this because if we're starting to see more clarification, maybe more countries aligning with the US, maybe more trade deals in the works, then we may not go down. We may not stop, right? This might be a little recovery, but this may have the wheels to say, hey, look, US, China, figure stuff out, stop this uncertainty, and the market all of a sudden comes back and has a big victory lap. Best case scenario, yes, we hit all time highs at 6,100, 6,200 the SPX. Why? Because U.S. and China stop playing tit for tat retaliation to figure out that something has to be done for the betterment of the global economy. Because right now, none of that's happening. Right now, the U.S. is fighting. Feels like the U.S. is throwing a tantrum. U.S. is jawboning. Fundamentally, things look very weak in the U.S. Global rotation is a real deal. We have non-U.S. assets performing extremely well. You have gold performing extremely well. And so to wrap things up for this little video, like I said, if we come back down to the lows, I'm taking off some near-term hedges. I'm looking to take in some directional trades at the downside just in case we have a bear trap scenario. I think from 48 to 47, 46, we could pop back into the 52, 53, 54 zone. 5,500 right now, major resistance. Could we form this low, then all of a sudden work our way all the way back to highs again? Maybe. I mean, you have to remember that recession predictions have climbed quite a bit this year, 20, 20%, 30%, now up to 50, 60%, depending on who you look at. Goldman Sachs, JP Morgan, some big names talking about some high risk recession concerns. But at the same time, projections have changed from 7,000 SPX or S&P down to 6,500, down to 6,400, down to 6,000. None of those really matter because they're all dead wrong anyway. Nobody's going to finish exactly where the market's going to be in December. But that being said, you're having recession indicators percentages go up. You're having forecasted levels based on what is the average move is around 8 to 10%. So what's the prediction? Well, if we're down 20+% and we have a reflexive move and then we have some gains on top of that, you're still looking at the market kind of finishing right around that like 5% to 10% on the year. So it's just adjusting what is the standard move anyway. It's super basic stuff. But I look, it doesn't mean anything. I think it's just numbers, and they're going to change. They're going to be forecasts will change all the time, and they'll be wrong. But from where I'm standing, I don't think anything good happens below 4,800. I think Trump will continue to be more and more vocal and soften his stance if prices push lower in the equities market. If the bond market breaks like it did, where we had that basically the Trump put pausing for 90 days, the bond market's going to have a reaction because breaking the bond market is way more important and it's way more damaging than breaking the equities market. The equities market, yes, we've got, adjusted returns and we could have a 15 to 20% drawdown to return 5 to 10%, but it's reflexive. The bond market is potentially a liquidity or credit event that hurts the entire world. It hurts funding, it hurts global economy, it hurts globalization. So breaking the bond market has way worse ramifications than a little volatility in the equities market for right now. So if we pressure the downside in the equities market, does that make the bond market stretch? Not necessarily break, but stretch. Okay, so before we go, let's go to XAU USD. 34.24, another print higher, all-time highs again on gold, up nearly 3% on the day. Looking back on gold, what could be happening here might be unprecedented. Gold to the upside. I did measure a move. This goes all the way back to 2009, 2010, 2011. One of the biggest bar counts that I've ever seen in gold, all the way back here. Let me go back further. I got to go back another decade. Here you go. So here is 2009's great financial crisis right in here. Okay, 2008's low in gold. We had a bar count on this red line. By the time we tested this red line, we had a break below, break above. We tested there, and we didn't hit that line again until there. That was a 2009 low to a 2011 retest. That was over 600 bars. Okay, right now we are creeping up on almost 400 bars on the current gold price. So that was around 630 bars in gold. Now, the reason I say that is because that's how high of a bar count we could have. That's how much of a capitulation move and bubble we could see in gold before it obviously underperformed for a long time. But what I looked at was this last little pop in gold. From this little pause, we had a push up in gold of around 29.5%. So I went ahead and measured that as history doesn't repeat itself, but it rhymes. So I pulled this out of the 2009, 2011 playbook. And this last little dip that we saw right here, where this pulled back to 29.60, if gold is going to see something similar, where gold is going into a bubble type price action, we have about a 28 to 30% area if gold gets up to around 3,800. So could I see gold running hot and the dollar getting weaker and something where this market has to break and bend and snap before we see a correction? Maybe. What would that be? Well, I think if the Fed came to the rescue, gold would probably dump hard. I think that if the dollar stops falling and the dollar pivots hard, gold will fall hard. If we see, I don't know if it's a central bank action from not just the U.S. but other central banks, if we start to see more, rate cutting and we see more liquidity, we see money supply increasing. I don't know, but right now, I mean, traders that ask me, what would I do in gold? Honestly, all I'm doing in gold is running with the bull market that has been my breakout trade since here and here and here. I've just been adding positions. I haven't added anything since this pullback, this resistance, this pullback. That is the last time that I added to gold. That's it. Now I'm in protection territory. So if we go up higher, we go up higher, we go up higher. All I want to do is take any stop loss that I have. I have positions in GLD, positions in PHYS, CEF, SLV. I'm going to run, if we get into this kind of bubbly territory, I'm going to run stop losses and start trailing very, very aggressively because this has been a great trade. I'm not interested in selling gold to call the top. I think that's crazy unless I see price action is so obvious that maybe I'll take a stab at it at a retest of the highs and then a failure. That gives me a big reward to risk scenario. That's the only way I'd short gold is if I had a monster reward to risk. But I have to see a lot more price action and evidence before I, anticipate the high. I think that's suicide right now. So I'm just hoping that if we continue to go higher, I'm just going to keep trailing stop losses. Perhaps we have that bubble type move where it's a 28, 29, 30+% move. On top of that, we are so far away from this 200 moving average, and our bar count last time we tested was over 380 bars. We are sitting now around 388 bars. So yes, I agree that we can go back to 600 bars, and it might be another year before this thing is broken. But by the end of the year, that puts us up to around 500 and change bars. That's a lot, and this stretch away move percentage wise is also pretty extreme. So all I'm saying on gold is enjoy it while you got it. If stop losses are getting put in and trailing, that's great. Any little small dips is probably still offering a buy opportunity, but any capitulation move where it's just more green, more green, more green. If we start to get like multiple large 2-3% moves on the upside, if we have more candles that look just like today to the upside, I think there's a gold bubble that is about to burst. And between somewhere, let's say 3,800, maybe even 4,000, I think at that point the bubble bursts. And don't be shocked to see not going to lie here, 30% correction. People think I'm nuts for thinking we could have a 25 to 30% correction in gold. But anybody that's been trading gold for 20, 30, 40 years, you have seen 30, 40, 50% corrections in gold. This is no different. It's just becoming a great asset that is showing its abilities for the last couple of years because it's been returning so much and it's been appreciating so much. And in the wake of a weakening dollar and times where it looks like the world is trying to rotate out of the dollar and rotate away from the U.S., gold has been doing really well. Silver, even though gold is outperforming silver, I still love silver to the upside. I have a measured move here towards 35.93 on XAG, and I have a measured move up here towards 48, which we've hit twice in its history. That was back in 2011 and back in 1980. If you go all the way back here on a silver chart, you'd have to go way back here. This is a 2011 high, and you go, I got to go way back on the daily chart. Let me just go back to 1980, and there you go. Is that it? Let me go to the weekly chart. 1980. There you go. So 1980 and 2011. But the nice thing on silver is it's been there. I can actually look at this and say, well, it's not unreasonable to think if we get all-time highs in silver that we could have a run to, $45, $46, $47. Again, I'm long silver. If we go up to these levels, once we start hitting some resistance zones, I will be protecting and trailing for stop losses. And then lastly, Bitcoin, another dollar alternative. And I talked about this for one of my live sessions this morning. I think that Bitcoin is showing a lot of resiliency. I'm impressed by that. I thought we would have, with the NASDAQ down 27, 28% peak to trough so far this year, that Bitcoin would have been probably pushing a 40, 50, 60% drawdown, which it hasn't. It's been contained to about 30% or so. Now, I think a lot of that is legitimate financial advisor discussion with this consolidation. A lot of big investors and funds, for that matter, are allocating anywhere between 1 to 3% Bitcoin, maybe as much as 1 to 10% Bitcoin. Obviously, there's all sorts of derivatives and things that are fancy, like, hey, we're just going to do sell covered calls, and we're going to have like a dividend portfolio, whatever. I want to trade something that relies on the spot price of Bitcoin. So I do like IBIT. I don't mind FBTC. But my point is this, after the ETFs were approved, this has now become an allocation to much, much bigger inflows. Bitcoin's ETFs, the IBIT ETF, did more in 9 or 10 months than GLD did in like 8 years. That's how much money and inflows came into this. So if this is, legitimate inflows with a very low percent exposure, I think this is where you're seeing the resiliency of Bitcoin. Nobody's selling Bitcoin. If I have a 1% exposure to Bitcoin and it's down 10, 20, 30%, I don't really care, because if it outperforms and it does what it's supposed to, you go back the last, 11, 12, 13 years, the whole point is Bitcoin at a 1% exposure has enough to help your S&P performance. If you were 99% S&P and you're 1% Bitcoin, your annualized returns end up being about 15 to 16% a year. That is more than roughly double the S&P just by having 1% Bitcoin. Okay. So I think that allocation is what is providing some additional stability. And the nice thing is right here on the technical side, I could see some resistance. I could see some range trading. But if we stay here and we remain above 74,000, 75,000, if we don't breach below that level, then I think Bitcoin continues to look better. If we have a risk on rally, if the S&P finds some footing, the NASDAQ finds some footing, we can find some risk appetite here. I think Bitcoin has a pretty good looking run to the all-time highs again. So gold looks pretty good, but beware of the bubble. And Bitcoin looks good because of the resiliency. S&P, look for key levels. I think we are going to be retesting, or if we do retest those lows, watch for those bear traps. I'm going to take some bites. There's a lot of noise within this 13.5% candle from last, it'd be April 7th, 11th, which is my last video I did. So beware of the noise. Beware of the gold bubble. I think there's still room to run on gold, but I hate buying it at these highs. I'm just running stop losses. Bitcoin, I have some exposure, and I'm looking to see if we can hit all-time highs in the next maybe 6 to 12 months. It might be sooner. Who knows? But in the interim, the things that are breaking, this is concerning to me. TLT is down 1.75%. We are seeing swings in the bond market that are probably making a lot of people nervous. The current administration should be nervous about this type of volatility in the bond market. The Fed should be nervous with this type of volatility in the bond market and the yield market, because that's where things are breaking. Okay, 10-year yields up, 20-year yields up, short-term yields are down. There's the 3-month down, 2-year is down, but the longer term, this is scary stuff. So I don't know if the U.S. has to make yields more attractive to entice foreign investors again. So maybe this does have to go up, but that is going to break the U.S. consumer. Something's going to break if we're above 5% in the 10-year, and if we're above 5.5, 6% in the 20-year. That does not look good for anybody in the U.S. right now. That is super scary and inflationary. I hope that's not the case. I hope this is just a bunch of noise and things kind of settle in. But I think what is so questionable is because it's such a large area of noise, nobody knows. I would say I'm gonna buy my lows. I'm gonna add my hedges, but in the interim, I'm just trying to survive and not do anything silly. That's the most important thing is, pick your battles. I'm doing a lot of, income trading days and weeks. It's not really long-term stuff. And then for, maybe a 30, 60, 90-day cycle, get positioned for some bites here, add in some hedges for 3 to 6 months out, trade some earnings over the next couple of weeks, as we have like 400 plus companies this week and over 1,000 companies next week. So I'll pick my earnings battles here and there, but I'm just going to do what I can to generate some income. So, all right, I'll follow up with that. Big shout out again to the TradingView community. Thanks for following along and checking out the videos. Hope this one helps, and there'll be more to come. So stay tuned. I'll see you soon. Thanks. Bye.